You see what I'm saying?
Yeah.
So,
Yeah. Yeah.
so my evaluation here is that this is not a bad deal if we can do certain things.
Okay.
One, we would have to look at and understand, does this person have a loan on this asset that is not it's not a bundled loan with all of his other properties, right? So if there's a loan just on this one and we can assume the loan, there may be some value here that we can work with. So basically, what would happen is we would say, okay, look, normally we would get a new loan. And in
Mm-hmm.
order to do that, it'll cost us X amount of money. And you'll save a bunch of
Mm-hmm.
money on, not a bunch, but you'll save some money on the closing costs. And if we've agreed to, let's say, 2.6 million with the seller,
Uh-huh.
and they say we'll work with you to help you assume the loan, or it's not a true loan assumption. Let's just use that as a placeholder terminology for what we're trying to do. But let's assume they have a $2.5 million existing loan. We agree to a
Mm-hmm.
sale price of $2.6 million. His equity
Mm-hmm.
is only $100,000, right? So instead
Mm-hmm.
of now coming to the closing table with all of the closing costs, all of the capex costs, plus the 30% equity that we need to bring to the
Mm-hmm.
table, you're only bringing the
Mm-hmm.
$100,000 and the capex plus a reduced closing cost. So you
Okay.
when you have to raise capital for that, you're actually having to
Mm-hmm.
raise far less capital.
Okay.
Do you understand what I'm saying? Does that make sense?
Makes sense, makes
So
sense. Because it's
so
already unusable, so we just take over the loan, and the costing of it would be much less, the
yes,
closing
because
costs and
he's
everything.
already he's already essentially paid whatever equity he's put down. I don't know if he and this is all assuming that the loan information I have is correct. The loan information I have could be completely wrong. So that's why we need to understand what kind of loan he has on this property. And if he has a
Okay.
loan on this property, what are the terms, how is it structured and all of that. And that'll help us to make a better informed decision. If we're going
Okay.
to
Okay.
pay cash for this property, essentially, when I say cash, I mean we're going to go out and get new debt, raise the capital, and pay off the existing mortgage, or just pay, him and
Yeah.
walk away, then the numbers don't look like it's a good deal. The numbers say that it's workable, but you're going to have a hard time raising capital with the returns that you're offering on the deal. And
Okay.
fundamentally, the premise that you're going to be able to get to the full market rent in 12
Mm-hmm.
months is flawed.
Mm-hmm.
It's going to take far longer than 12 months to get to the full market rent.
Okay.
I would
Okay.
conservatively say that it's going to take at least 18 months and closer to 24 months to get to that point. So
Yeah.
based on that, we would have to say 2.6 is even too high. It needs to be like way lower than 2.6.
Oh, really?
Yes. And
Okay.
I'll give you
So
one
what?
more piece of like my thought process here. He's
Okay.
tried to market this deal on his own with no broker, right?
Mm-hmm.
I would assume that there have been multiple people like you that have reviewed this and have made him an offer of some sort. And he has come
Mm-hmm.
back to you because your offer is the highest of all of the other offers he's received. Now, he may have received no other offers, which is also possible. But my guess is that he's probably talked to some people that have reviewed this deal and either have said, there's just no way I can even make a reasonable offer on this, or they've made him such a like low offer that it's not worth it for him to
Yeah.
take it.
Yeah.
But
Yeah.
your offer is the
What he
highest offer that
mentioned.
he's received, right? That makes
Yeah.
sense,
What
right?
he mentioned. Yeah. What he mentioned to me, he had two offers which were higher than me, but they were asking 10% equity. For him to to hold the 10% equity or something like that. Yeah.
Okay.
And again, this works, right? So I don't know.
That's yeah. I guess but so what would have happened is, I mean, if you think about it, even with the higher offer, right? And his 10%
Mm-hmm.
equity, he's walking away with less cash than your $2.6 million 100%
Exactly.
buyout,
Yeah.
right?
Yeah.
So
Exactly. Yeah.
the offer couldn't have been much higher than what you had offered him, because with 10% equity, it's essentially a full 100% offer, right? So
Yeah.
I don't think anybody has really offered him what he thinks this property is worth or what he paid for it when he bought it, because when he bought it, it was like 2019, 2020, when property values were crazy, right? And he
Yeah.
bought it at a
Mm-hmm.
very low cap rate, which means he overpaid for it at the time that he bought it. And I don't know
Yeah.
if he's in a situation, and this is why it's important to ask what is his loan situation, because let's say he had a 24-month interest only loan, and now all of a sudden he's having to pay interest on top of his, he's having to pay the principal. Maybe he's not able to pay the full amount because the rates were crazy. There's all kinds of reasons why he may be in a cash crunch situation. But I mean, it also could very well be that he just wants to go out and buy, a gas station or something else. But if you have a performing property, right, I'd be very hard pressed to say, why wouldn't you just hold on to it because it's cash flowing really well? Like, what are you going to do with the equity that you have in this asset? And where are you going to take it and put it into some other asset that you're going to get a better return?
Yeah.
So all that to say that this is not a bad deal, but it's not a great deal either. I would say we need to ask him what kind of loan he has and if he would be willing to work with us. If it's a favorable loan situation, if he'd be willing to work with us to where we can assume the loan or take over the loan, right? I wouldn't even call it assuming, because assumption means that the loan would have to be transferred into the new entity's name. But I would phrase it more along the lines of taking over payments, right? So the loan still stays in
kind of a deal.
Yeah, exactly. It's a sub two. Exactly. And then pay him his equity of whatever that works out to of the loan, the sale price minus the loan, and pay him that. And then, sub to the loan, and we raise less capital, which means that for the people that we do raise capital from, they get a much better return because we're sharing the proceeds with a smaller group of people, right? And your equity percentage is much higher for the people because we have to raise less money. So that would be my take on this. Does that make sense?
Yeah, it does make sense. I can reach out to him and ask him what if he has a loan or not, and if he does have a loan, what are the terms that he has, like interest rate and stuff, and if he is willing to share that information right now. I'm not sure, but I can go ahead and reach out to him and ask him.
Okay.
What else do you think?
I think that's a good idea. Just, talk to him. And if you want me to be on the call with you, I'm happy to do that too. We can do like a conference call with him and we can just ask some very, simple, basic questions like that.
It's really nice. Yeah. If you be able to join the call, I mean, I would really appreciate that, man.
Yeah, absolutely.
You seem to have a lot more information than me, man. I'm still learning. So yeah.
No, I get it. It takes time, like it's not hard, but at the same time, it's not easy either, because you can get fooled by, a spreadsheet and you look at it and you go, oh, this looks fantastic. But like I showed you, like if you make one assumption that is very optimistic in your favor, right? Then the numbers could look really good and you're like, oh, wow, this is a great deal. And just by simply doing one thing from changing your the time it's going to take for you to go to full market rent from 12 months to 18 months will make a big difference. Like it'll that alone will kill your deal in a heartbeat. You know what I mean? So yeah, it's good to be conservative in your estimates on how quickly something is going to happen, how much something is going to cost to renovate or to bring up to code, how much of a likelihood is there that something is going to break or you have to spend a whole lot of money that you didn't originally estimate that you had to spend. Let's talk to this guy. Let's see what the situation is. And just like he came back to you, at 2.6, we may have to just say, look, we ran the numbers again, and unfortunately, we don't think we're going to be able to get a loan for this. So thank you, but we just can't do it unless you want to really renegotiate. And, this is where we would be. I would say this property needs to trade somewhere around 2.1 to 2.2 million is what this property needs to trade at.
Oh, okay. Okay. Yeah, I mean, it makes sense what you're saying, but I just have that question, and our underwriting team are not considering all those factors that you just mentioned. I mean, it makes sense, though. I mean, it will take about 18 months to 24 months to renovate the property and put it on the listing again. So I'm just curious to know how they are evaluating, because that's the number they came up with, right? I mean, 2.5 It's the number 2.540 is the original number that they came up and told me, okay, that would be the number you wanted to go with.
Yeah.
So,
So my answer to that question would be they're a good group of people. They have a lot of knowledge and they're going to help you. But at the same time, they have lots of people sending them spreadsheets and deals to evaluate. They're not
mhm,
really going to be spending a whole lot of time reviewing
mhm,
things. And ultimately it's your money, your time, and your effort. So for them to say, yeah, it's a
mhm.
good deal, it's still up to you to verify what they're telling you.